Thursday, the 9th of March. Market analysis, Stan Ehrlich. We always start out with the indexes and the spider. Well. This is a little more weakness than I was expecting. We have an outside down day, or what is normally called a bearish engulfing candlestick. And we also have it in the DIA at the moment. Now, not in the QQQ, and we'll look at those charts in a minute. If we stay lower than yesterday's close, this will be an outside down day, and that can cause more of a break. Normally, bearish engulfings do cause the market to go down. We're not anywhere near oversold enough to talk about turning around because of RSI. We have some support. The neckline of the original head and shoulder bottom formation that started in June, October is the head, and late December is the last shoulder low, outlined in thick green lines at the bottom here. And of course, email me at info@ersignals.com if you have any questions. That neckline, which I just put some anchor points on, handles, as TradeStation calls it, is right at today's lows. We are also still trading above the 200-day Dow Jones long-term Dow Theorist moving average, which has actually started to turn up, not on the screen, actually started to turn up for the first time in a year in the last week or so, slightly. So you could say it's kind of flat, but a tiny bit upward now. Of course, due to the rally we had at the end of last week and topping out on Monday of this week. Now, that's support, the neckline. Next, we are at a bunch of previous lows, and I will expand the daily chart to be more exacting. Right now at the neckline, we are a little below all of the other previous closing prices except one on March 1st. The next day, we had a bullish engulfing that worked for a couple of days. But now we have a bearish engulfing. Now, it's not an ER sell signal because we were not overbought. Otherwise, it would be. We also have a support level that we bounced off of with that bullish engulfing at Thursday of last week. That's another support level. So some lows and closings, a couple of important trend lines or horizontal support lines. And that's pretty much about it for the moment as far as support is concerned on the S&P 500 spider. Now, basically, the same thing can be said for the E-mini and the micro-mini and so on and so forth, with minor variations. And I have a damn alarm line going off. Excuse me for a second. Let me get to it and get rid of it. Okay, I think that was actually the neckline alarm line going off. So let me edit out the alarm real quick. Sorry about this. And that wasn't what I wanted, so I'm just going to leave it alone unless it bothers me again. We're now below it. We are now on the left chart, 30-minute chart on the left. New lows for the day by a chunk. And look at the last hour and a half or so, dropping quite a bit. Below yesterday's low, of course, that makes the outside down day. And the major low of consequence here is 392 and a quarter. We're 95 and a quarter. Currently down on the day 375. So we're not down that much. We could do it. We could make a new low for the whole trend, which would kill almost all of my bullish expectations and start me to turn a bit, and I hate to say it, bearish. But you got to follow your disciplines. Doing this too long to be stubborn. Never be stubborn. You can never make the market do what you want it to do. You always have to move with it. And I'm going to have to turn at least neutral, depending upon circumstances, if not bearish, if we get below and close below 392. That's it. That will be a new low since late January. Almost 2 months after a rally that failed to make any new highs. Actually, a couple of them. Okay, let's go to the DIA. Going to my index page, let's look at the daily data on the DIA, the Dow Jones Industrial ETF. And it has an outside down day also. Plus, it is currently a potential new low close. So, whoa, wait a minute. Since November 9th. I said a new low close. And this is the second lowest close since that date. That's right. November, December, January, February, for the last 4 months plus. This is going to be, could be, might be a new low close for a very long period of time. That is normally not bullish at all. In fact, without even being close to oversold, we would have a downside breakout. We could get down to the support line at 319. We're at 326 almost. We could get all the way back down to another support line at 314. Very important right here. If this holds and we turn up, especially if we can close higher in the day and we're not down that much, it would be a great big reversal and a complete change of my little scary comments at the moment. But I can't help it. It's not starting to do that yet. It's still hitting new lows periodically and relatively quickly, every 10, 15 minutes, if not sooner than that. Now, the QQQ just did it. The QQQ also has a bearish engulfing. Wow. All three of the major indexes. The Russell 2000 just simply crashed, by the way. I don't talk about the Russell very often. I have a little menu problem. And here's the Russell. It has already made a new low since January 19th. A sort of a downside breakout. Now, the major long-term bull trend line is still a ways away. So as far as the long-term trend is concerned, it's just a little iffy, but it's basically still up. And I want to point out on the S&P 500 daily chart, which, come on, don't give me a problem here, is coming up here. We have apparently broken that bull trend line, but it's, just a moment, I'll put it on this chart real quick. Yeah, it's been broken, then we went back up above it again, and now it's broken again. There aren't any bull trend lines since the October 13th low that are relevant, so that's not good. And we did it a couple different times and just don't seem to be holding above that only significant bull trend line we've got on the S&P. Watch out, people. This could turn into a waterfall kind of type of a move down. It could get very bearish very fast. And we're not, remember, down that much on the day. Only 2 or 3 points at this moment. It's 10:53 California time. We got 2 hours and 7 minutes to go before the close, which is plenty of time for what I call a waterfall type move. It just goes down faster and faster and faster until the bell saves the day. That, so I'll just throw that out there. Futures contracts. Corn. I've been talking about corn for weeks now, and there it is. There's no ifs, ands, or buts about it. After the downside breakout, new lows since October, 2 weeks ago, and getting oversold, having a typical normal bounce I talked about, could have even bounced a little further, but it didn't, and turned around and wham, yesterday and including today, of course, making new lows by quite a bit, a real slap in the face, so to speak. Breakout, new lows again, now since August 19th or so. Wow. Okay. This is a bear market. I'll be looking for a challenge of the bottom. Let's call it 560s. Another level would be 580. Well, let's talk about 580. We're at 611. So that's plenty, 30 cents lower. Plenty of room for significant profits in futures. In the next, I'm going to say 2 to 4 weeks. We're getting oversold right now, so we deserve a bounce. That's going to take a few days, maybe even a week. Then it's going to take a little bit to make new lows after that. Stair-stepping down market, just like you saw in this last week or so. That's corn. Don't want to spend too much time on it. Coffee, pass. Pass on the, oh, that's the bond market. Now look, bonds are at the highest closing price for the last few days. actually the last 2 weeks. So what's driving the stock market down is not interest rates going up. This shows that interest rates are actually slipping a little bit on a short-term basis because the prices are going up. And I believe the next chart here is, well, I'm going to go to silver. I'll get to 10-year notes in a moment. These are a little bit out of order. Oversold condition. I expect another minor rally, but the trend is down. 2 buy signals made a little bit of money for a couple of days, more likely than not profitable trades for ER1 and ER3. And now maybe I'll get another buy signal and have another bounce. One of these green lines hopefully will be a profound long-term trend change buy signal. The last 2 made a little money, but they weren't obviously the long-term ones. Next chart. 10-year notes, good. Also had a buy signal that didn't work a couple of weeks ago. They tend to cluster. We see them sometimes be 2 or 3 or even 4 in about a month period of time or less. This is a new high and a new high close for a few days. Just like the bonds, this is the 10-year notes. So it's not interest rates that are pushing it down. It's got to be some other pieces of information and or rumors or whatever. And you know I'm not a funny mentalist. Oops, I'm sorry, fundamentalist. So the fundamentals are always late by design. They're never, almost never, timely, known by the general public the moment they happen. They're known by a lot of other people before the general public finds out. And they're always late to be calculated on the average. So that's my comment about fundamentals. I agree. They make a long-term trend keep moving. Fundamentals are important for long-term trends, but they're not particularly useful to me, especially on a turning point day. My ER signals certainly are. Next chart. OJ, pass. Hogs, pass. COOD, big long-term sideways trading range for months now. Long-term bear market, and we did get a bearish engulfing at the top of this market way back in June, way up there at 116, and here we are at 176. Not to imply that you would have been short all the way down. You could have been if you had a very slow, smart trailing stop, or STS. Very much so. It would have done that. But your stop is way far away. That's the problem I don't like. Next chart. Heating oil. About to break out through those green lines I've been talking about for weeks now. You break below those 2 green lines and you got a huge bearish signal long term. Next chart. Wheat getting very oversold at 12 3/4, about to turn back up again. Next chart. Live cattle, no comment. Natural gas. We picked the bottom of the market so far, been going sideways for 3 or 4 days, and our low day and the low for the whole trend with our ER green daily color was on February 22, the bottom to the day. Next chart. E-mini at the neckline. Very important that it try and turn around or succeed in turning around ASAP. I mean, immediately, and it just isn't happening. It's not anywhere near oversold. I don't have any problem with it going down more at this point, except that I just wasn't expecting it. It's not holding. We are starting to get a whole bunch of holes in the bullish story. This is gold. The buy signal we caught so far is the bottom of the break. Came down and came very close to it yesterday, and now rallying back up again very sharply. This is acting like that low that we caught on February 28th could be a very good intermediate, at least maybe even longer term buy signal. You know how gold theoretically tends to go up or goes up in a bear move in the stock market. The flight to quality, safe haven concept. Next chart. Platinum, same comments overall. Actually held up better. Silver didn't, but gold and platinum are providing evidence that the reversals several days ago are maybe going to be much more profound. Next chart. Sugar, no comment. And I'm going to get back that soybeans, no comment, to corn, I believe, in a moment. High grade copper, no comment. Cocoa, no comment. Bean oil. I'll go back to bean oil. Starting to break down on bean oil. We are making new lows. since, and there's no support to speak of underneath the market since September. This could be a major downside breakout in soybean oil coming up here. Yeah, I think I'll put some trend lines on this, or support lines on this chart for tomorrow. And it would be definitely under the low of September 28th. And probably also under the low here of December 12th, last December. Next chart. Here we are, corn. Have a great trading day. Stay in our lick. Bye-bye.